In the late 1920s, the United States was hit by an economic catastrophe that would define a generation, the Great Depression. It all began with the stock market crash of October 1929, when billions of dollars were wiped out in a single day, plunging the country into financial chaos. Banks failed, businesses shuttered, and unemployment soared to unprecedented levels, reaching nearly 25% by 1933. Families lost their homes and life savings, and breadlines became a common sight in cities across America. The Dust Bowl, a severe drought coupled with poor farming practices, devastated the agricultural heartland, displacing thousands of farming families.
Hello everyone. Welcome to the special weekend edition of Markets Around the World. I'm K2, and we have some exciting news and data to discuss today. We'll dive into the latest updates, analyze key macroeconomic trends, and highlight the critical levels you need to keep an eye on. If you're as passionate about the markets as we are, be sure to subscribe and deepen your understanding of how global markets interconnect. In this episode, we'll explore a wide range of data, news, and macroeconomic developments. So let's dive into what's been driving the markets and take a closer look at what lies ahead, as well as what has happened in the markets and what the outlook might be. Let's start with the top headlines that are making waves. Oil prices have risen this week amid fears that Israel might target Iran's oil infrastructure in retaliation for Tehran's missile attack. However, OPEC Plus has a buffer of 5.8 million barrels per day in spare capacity, which could offset any loss from Iran's 1.7 million barrels per day, according to Robert Yager of Mizuho Securities. OPEC Plus is also set to increase output soon, gradually phasing out 2.2 million barrels per day in voluntary cuts, starting with 180,000 barrels per day in December. Traders analyzing the weakening US dollar are focusing on the relative strength of global economies as rate cuts from central banks impact currency markets. The US dollar index, DXY, fell 4.8% against a basket of currencies in Q3 2024, marking its worst quarterly performance in nearly 2 years. The dollar faced added pressure after the Federal Reserve implemented a 50 basis point rate cut last month, its first since 2020. Asian shares retreated from a 32-month peak on Thursday, as the intense rally in Hong Kong took a pause, prompting a broader market pullback. Despite the overall retreat, Japan's Nikkei index saw strong gains, fueled by diminishing concerns over further monetary policy tightening this year. Investors in Japan responded positively to signals from policymakers that suggested a more cautious approach to future rate hikes, boosting sentiment in the region's markets. However, elsewhere in Asia, traders opted for caution, taking a breather after recent robust gains. Tesla's stock is under pressure despite slightly beating delivery expectations for the third quarter. The company reported 462,890 vehicle deliveries, just above the 462,000 analysts expected, with the Model 3 and Model Y making up most of the total. Analysts had been optimistic heading into the report, with some forecasting as many as 470,000 deliveries. Wedbush's Daniel Ives noted that while the result was solid, it fell short of higher expectations from some on Wall Street, who had hoped for an additional 3,000 to 5,000 units. The U.S. stock market is now more expensive relative to fundamentals than it was at the peak in 1929, raising concerns amid global instability and an economic slowdown. The S&P 500 currently trades at a Shiller price-to-earnings ratio of 35, higher than its 1929 peak of 33. This measure, developed by Nobel laureate Robert Shiller, has historically been a strong predictor of future returns. Only two periods, 1998 to 2001 and the post-COVID surge, have seen higher valuations, both of which were followed by market downturns. The union representing 45,000 U.S. dock workers at East and Gulf Coast ports has reached a deal to suspend a 3-day strike until January 15 to allow for further contract negotiations. The International Longshoremen's Association and the U.S. Maritime Alliance tentatively agreed on wages, with ports increasing their offer from a 50% to a 62% wage hike over 6 years. The final agreement still needs to be ratified by union members. A housing affordability crisis continues, and it's unlikely to improve soon, according to a prominent economist. While a recent drop in mortgage rates spurred refinancing and increased listings, home buying demand remains low. This is largely due to the lock-in effect, where homeowners are hesitant to sell and give up their ultra-low mortgage rates, keeping listings suppressed. Now let's review some economic data. I want to show you all what we're looking at, and we'll begin with historically, 5-month winning streaks in the stock market have often been followed by significant gains over the subsequent 6 months and even throughout the following year. This trend suggests that the S&P 500 could see continued positive momentum, potentially leading to strong performance as we approach 2025. If this historical pattern holds true, it could serve as an encouraging signal for investors, indicating that the market may be poised for further growth in the months and years ahead, despite any near-term volatility. As of October 2nd, the market appears to be at a potential seasonal peak, and short-term volatility is likely as we approach Election Day. Historically, however, the market tends to recover after elections, creating potential opportunities for gains in November and December. Historically, some of the largest market drawdowns have occurred in October, but I don't believe this year will follow that trend. Greed is high, and bull spreads are very extreme, with bonds showing signs of weakness. Yet none of these factors seem to matter to a market that remains imbalanced. This month's top focus will be on how to trade the kangaroo strategy. Below is the October performance and event calendar. Feel free to save it for later if you need it. This chart displays the S&P 500's 12-month average returns following the last 10 Federal Reserve rate-cutting cycles, categorized by the reason for the cuts. Normalization cuts resulted in a 13.2% average return. Panic cuts, in response to urgent market conditions, led to a higher average return of 17.4%. Recession cuts, however, resulted in negative returns of negative 11.6%. Welcome to the best first 9 months ever in an election year. The S&P 500's exceptional performance in 2024 could indicate strong investor confidence and economic resilience, presenting a potential opportunity for those looking to take advantage of bullish market momentum as we approach the upcoming election. That's a great question, especially since many people remain quite nervous. For instance, the Volatility Index, VIX, spiked over 10% today, despite only a slight decline in the S&P 500. This suggests the stock market may not handle bad news very well. Next week brings the September non-farm payrolls report, and earnings season kicks off soon with the banks leading the way. Could we see an earnings warning or layoffs from a major company? It's uncertain, but if bad news emerges, it's quite possible the market could take another leg down in October. As for the question of whether the market could crash, we need to define what crash means. Over the past 74 years, the S&P 500 has experienced a 9% or greater decline in a calendar month only 17 times, about once every 4 years. If you're anticipating a 20% to 30% drop or worse, I'd say the chances are extremely slim, probably negligible. That said, October has seen some infamous crashes. In 1929, the market began its steepest decline in history, eventually losing nearly 90% of its value. The other notable October crash occurred in 1987, known as Black Monday. If you weren't investing back then, this is what the chart looked like. The 1987 crash unfolded over just a few weeks, unlike the prolonged decline in 1929, which spanned several years. While there have been other difficult Octobers, none have been as catastrophic as those in 1929 and 1987. In fact, as I mentioned earlier, since 1950, there have been 17 instances of calendar month declines of 9% or more, and October has often played a role in these drops. Additionally, out of the 14 bear market declines, losses of 20% or greater from all-time highs since 1950, October has also been a pivotal month in many of these downturns. So, what might we expect in October 2024? The last data point I want to show you is that U.S. job cut announcements are on the rise. In September, U.S. employers announced 72,821 job cuts, a 53% increase year over year, according to data from Challenger, Gray & Christmas. This marks the third largest number of September layoffs since the 2008 financial crisis. In the third quarter of 2024 alone, companies announced 174,597 job cuts, a 19% increase compared to the 146,305 seen in the third quarter of 2023. Year-to-date announced layoffs now stand at a staggering 609,242, nearly triple the number from 2022. Cost-cutting has been the main driver of these corporate layoffs. So, is the labor market really as strong as it seems? Now let's take a look at S&P 500 heat map. The tech sector shows mixed performance, with strong gains in semiconductors but declines in major players like Microsoft. Energy stocks are surging, led by ExxonMobil, possibly due to rising oil prices, which could offer short-term opportunities. Technology sector, mixed performance with Microsoft, MSFT, down minus 2.79%, while NVIDIA, NVDA, and AMD are up by plus 2.90% and plus 3.98% respectively. Communication services, positive performance, with Meta up plus 5.04% and Google up plus 1.98%. Energy sector, strong performance from ExxonMobil XOM up plus 7.78%, driven by rising oil prices. Healthcare sector, Merck down significantly minus 3.45%, while Eli Lilly gained plus 1.07%. Consumer discretionary, mixed, with Tesla TSLA down negative 3.98%, while Amazon AMZN is slightly down at negative 0.78%. The Fear and Greed Index is currently at 74, indicating a state of greed in the market. This suggests that investor sentiment is optimistic, with more willingness to take on risk. Historically, high levels of greed can be a signal of potential overvaluation, increasing the likelihood of a market pullback or correction. The most anticipated earnings releases for the next week starting October 7th. Key companies include Tuesday, PepsiCo before the open. Wednesday, Delta Airlines and Domino's Pizza before the open. Friday, major financial firms such as J.P. Morgan Chase, Wells Fargo, and BlackRock, releasing their earnings before the market opens. This week is critical for earnings, especially with large-cap companies like PepsiCo, Delta, and major financial institutions reporting. Investors should pay close attention to the earnings from these key players, as their performance and outlooks could have broader market implications. Let's take a look at some charts, starting with the SPY 4-hour market, which is nearing an all-time high. If the price moves above 573, we could see it reach 580 by the end of the week, as the market is expecting a 109-plus implied move for SPY. However, the bear case would be confirmed if the price falls below 564, signaling that the bears are taking control. Next chart, QQQ 4-hour. If the price moves above 487, that's a bullish signal. However, if the price is rejected at 487, we could see an ABC pattern to the downside, with 464 as my profit target. It's shaping up to be a big week ahead. Here are the key economic events for next week. Monday, October 7th, FOMC members Kashkari and Bostic speak. Watch for insights into Federal Reserve policy direction. Consumer credit, August, a key indicator of consumer borrowing trends. Tuesday, October 8th, exports and imports, August. These data points will provide insight into trade balance and global economic activity. Atlanta Fed GDP now, Q3, real-time estimate of GDP growth. EIA short-term energy, outlook, energy market trends and forecasts. FOMC member Bostic speaks, further potential insights into Fed thinking. 3-year note auction, indicator of government bond demand and interest rate trends. API weekly crude oil stock. Indicator of crude oil inventories, affecting oil prices. Wednesday, October 9th. Crude oil and Cushing. Crude oil inventories. Key data points for oil market traders. 10-year note. Auction. Watch for investor demand in government bonds. FOMC meeting minutes. 11 a.m. Detailed insight into recent Fed discussions on rates and the economy. FOMC member daily speaks. Additional insights into monetary policy. Thursday, October 10th. Continuing and initial jobless claims. Indicators of labor market health. Core CPI, month-over-month, year-over-year, and CPI, month-over-month, year-over-year, September. Key inflation metrics that will influence market expectations on interest rates. 30-year bond auction. Gauge demand for long-term U.S. government debt. Friday, October 11th. Core PPI, MOM, and PPI, MOM. September. Producer price data that helps assess inflationary pressures from the supply side. Michigan Consumer Expectations and Sentiment, October. Key measures of consumer confidence. All right, ladies and gentlemen, that's all for this video. If you found value in it, please hit the like button and subscribe to the channel. If you have any questions, feel free to drop them in the comments below, and I'll get back to you as soon as I can. Thanks for watching, and I'll see you guys in the next one. Bye for now.